In today's video, we're going to talk about how money works in business and why so many struggle. A key concept you need to understand is cash flow, which is simply how money moves in and out of a business. It's super important for entrepreneurs, investors, and even managing your own personal finances. So why? Because a business can have a great product, a ton of sales, but if they run out of cash to pay the bills, they are in trouble. In fact, a study by US Bank showed that 82% of businesses fail because of cash flow problems. You will see why cash is king by the end of this video. We will break down what cash flow really means, how to read a balance sheet, and how positive cash flow loops can help businesses grow. Plus, we will talk about how these ideas apply to personal finance as well. I am Gustav Buder, entrepreneur, investor and former fintech CEO. I co-founded Paytrim, a card payment acquiring platform with 3 billion in payment volume, raised $50 million and secured partnerships with Visa and Mastercard. I saw firsthand how the financial system really works, not just from the outside as a trader, but from the inside as a fintech founder. And what I learned, most people work their entire lives for money, but the truth is, money is your stored energy. And the system is designed to extract your energy through inflation, debt and financial traps. So that's why I left, to help entrepreneurs, creators and future investors flip the system in their favor. First, what is cash flow? It's simply the total money coming in and out of your business over a period of time, like a month or a year. Let's take an example of a property rental business. The money coming in could be rent payments from tenants. The money going out could include marketing costs to find new tenants or buyers, property-related costs like repairs, property taxes or insurances, and overhead costs like office rent, staff salaries or accounting services. Then we have investment in future growth like buying in new properties. At the end of the month, you will calculate your net cash flow by subtracting your outgoing expenses from your incoming cash. For instance, if you collect $40,000 in rent and spend $25,000 in expenses, then your net cash flow is $15,000. That's positive cash flow. Extra cash you can use to reinvest or pay down your debt. But if your expenses exceed your income, you will have a negative cash flow, meaning you need to cover the difference by dipping into savings or borrowing money. Now, profit is not the same as cash flow. Profit is the total amount that you have left after you paid all your expenses. But it doesn't always mean you have the cash available right away. For example, if a tenant rent is due in 60 days, you don't have the cash now. It's just a promise. Cash flow is all the cash you have in hand. So the main takeaway here is to always monitor your cash flow. Whether it's monthly or yearly, keep track of your income and expenses. This helps you spot problems early. If you notice one month you spent a lot on repairs and had a negative cash flow, you will now know to prepare for that in the future. Next, let's talk about the balance sheet. If cash flow is like your business heartbeat, the balance sheet is like a snapshot of its overall health. It shows everything your business owns, assets, and owes, liabilities, at a specific point in time. So the balance sheet follows this formula. Assets equals liabilities plus equity. Assets are what your business owns, like cash, properties or inventory. Liabilities are what you owe, like loan or unpaid bills. Equity is the value left after you subtract liabilities from assets. For example, if your rental property business owns an apartment building worth $500,000 and has a mortgage of $300,000, your equity is the $200,000 difference. Let's break it down. Assets are your cash, account receivables, which means money someone owes you, property holdings, like the buildings you rent out, and inventory. And what is a liability? Liabilities are basically money you owe, like loans or bills, to any of your suppliers. What is equity? Equity is the amount that is left for the owners after all debt is paid. This is like the net worth of the business. The balance sheet is a good way of seeing how strong your business is. If you have a lot of cash and a little debt, you're in a strong position. If you have a lot of debt and not much cash or property, that's risky. So what happens when you have a positive cash flow? It creates a positive feedback loop, also known as the positive cash flow loop. Here is how it works. First, you generate positive cash flow, which means more money coming in than going out. Second, that extra cash flow increases your equity, which means your net worth. Third, having more equity makes it easier to borrow money or attract investors, because it shows you're financially stable. Fourth, you use that extra cash or borrowed money to invest in more assets, like buying more rental properties. Fifth, those new assets generate more income, which increase cash flow, which boost equity, and the cycle continues. This loop is how small businesses grow into bigger businesses. For real estate investors, it's like the B with 4R method. Buy, rehab, rent, refinance, repeat. You buy a property, you get it rent out, you refinance it to pull out the equity and use it to buy more property. As long as your properties generate enough rent to cover the mortgage and the expenses, you can keep growing this loop. Let's talk about what happens when cash flow turns negative. This can lead to a negative cash flow loop, a vicious cycle that can create serious trouble. If your business cash flow loop is negative, it means you're spending more than you're earning. At first, you might dip into savings to cover the gap, but if this continues, you will run out of cash. Missing payments to suppliers or lenders can damage your relationships to credit, making it harder to get loans or even buy more properties. If negative cash flow keeps going, you might have to sell assets quickly to raise cash. But selling under pressure often means you won't get the best price for those assets, which shrinks your equity. If your assets lost value, for example property prices drop, your equity could drop even further. This cycle can continue, eventually leading to bankruptcy or the closure of your business. The key to avoiding this is to act quickly when you spot negative cash flow. Cut out unnecessary expenses, increase income, or secure temporarily loans or funding to get back on track. Let's challenge the traditional mindset about personal finance. The old advice says you should get a high-paying job, save as much as you can, and slowly climb the corporate ladder to acquire wealth. I think that way of thinking is outdated. Instead, start thinking of your personal finance like a business. Here's what that means. Focus on expanding your income by acquiring assets, not liabilities or consumer products. Assets are things that put money in your pocket. The first step to doing this is learning a high income skill. This skill becomes your personal cash flow engine. Once you have a strong income, don't just save, invest. Put your profits into scarce, appreciating assets that increase your purchasing power and create leverage. Now, repeat that loop. Earn through your skill, invest the profit in cash flowing assets, and use the returns to invest again. Over time, as your asset base grows, you can start using smart leverage, meaning debt, to acquire even more income-producing assets. This will create a positive financial spiral. The more assets you have, the more income you generate, the more you can invest. What I want you to focus on is assets that bring in actual cash flow or profit into your personal economy. Whether that's real estate, online businesses, or investments with high profits. By thinking like an investor or acting like a business owner, you will set yourself up for long-term financial success. Whether you're running a business or managing your personal finance, the key is understanding cash flow. Positive cash flow allows for growth, while negative cash flow can lead to a downward spiral. By monitoring your cash flow, making smart investments, and using debt wisely, you can build a strong financial foundation. Thanks for watching. I hope this breakdown helps you understand how money works in business and in personal finance. Remember, it's not just about being good at math. It's about understanding the flow of money and making sure it works for you.